Hey, good afternoon, everyone.
Good evening, Professor.
How are you, Malaysia? How are you? Hey, good afternoon, Jasmine. Good afternoon, Coral. Good afternoon. Good afternoon, Rostam. Rostam is, yeah, I guess Rostam has just joined the session, right? Rostam, good afternoon. All right. Um, all right. So today we are moving on to topic 6, stock valuation. Okay, so uh, course material, topic 6. All right, so we're going to be using this PowerPoint. I mean, there's an extra PowerPoint here, uh, and the Excel file for uh, topic 6 is this one, stock valuation.xls. All right, so let's go to the first video and take a listen. Yeah, hi, good afternoon, Zainab. All right, let's take a look.
Hi, greetings, and welcome back to the continuing lecture in Principles of Finance.
Okay, let me skip that.
Remember, our last discussion was about the risk and return. We stopped at the basically we had a discussion about the properties of normal distribution and the how the normal distribution can be used to make make a precision precision forecast about the expected return with probabilities associated, and also how it can help us to prioritize the asset allocation in our portfolio, and how it can be used to measure the risk return trade-offs, right?
I guess I'm seeing a raised hand. Jasmine, do you have a question? It looks like you raised your hand. Jasmine? Okay, I guess.
No, I'm
Jasmine?
sorry. My screen is locked. I didn't realize I raised my hand. I'll put it down.
Okay, all right, no problem, no problem. Okay, let's continue.
So there's further there's more material to discuss as far as the risk measurement is concerned, how we can reflect risk correctly into evaluation, and etc. But that topic is more advanced. We can discuss it only after we have covered the stock valuation models. Okay, so we're going to be we're going to be starting.
Oh, in addition to that, just incidentally, quiz two announcement was issued, right? You must have seen it. You must have received the email. Also, it is visible in the announcements, right? And so it's going to start. Actually, today is Monday, Tuesday, right? So it's going to start tomorrow. We've covered already, enough materials for quiz two. It's going to cover basically bond valuation and risk and return part one. Okay, and I don't know if you have realized, but this week is the kind of last week. I mean, next week we have Monday and Tuesday, but pretty much this week is um, critical point, right? Um, all right, so just reminding you that it's there, and let's continue.
With the stock valuation from today's lecture, but once valuation models are completely covered, then we're going to return to the risk topics again. Okay? So first of all, this is the PowerPoint file posted in our temporary lecture notes folder. So this is the only PowerPoint file. The other one is PDF, and still the third one is Excel. So I hope you're also, as you're watching this video, you cannot open it at the same time unless you use a separate computer. But you can always return. You can always go to the lecture notes course materials folder and check it out yourself. So let's make first of all a very basic distinction. When we say stocks, right, there are two types of stock actually: common stock and preferred stock. Now, stock is also called that because in the you remember from the financial statements, specifically the balance sheet. The balance sheet is representing the capital structure. Remember that, and equity is the long-term capital provided by the owners. So it means ownership, right? So common stock means ownership, but preferred stock is not ownership. Okay, preferred stock is not true ownership because with ownership, with every ownership, there should be a voting right. It should be a voting right. Voting right is basically is the proof that you have the voice. You have the voice in decision-making matters, right? So that's why common stock is the true and preferred stock is not. I mean, just because the name is preferred, it doesn't mean it is really, it is superior to common stock. Common stock is actually the real deal, the real stock. Now, preferred stock, there's a reason why it's called preferred stock, and the preferred stock is called as such because when the company pays out dividend, right, preferred stock owners get paid first, right, prior to the dividend paid out to common stock owners. And other than that, preferred stock is pretty much, preferred stock doesn't have anything superior over common stock, especially it is lacking voting right. But also there is something else, some other, something like tax advantage. But without further ado, let's go into this slide. First of all, stocks can be owned privately by private investors, or closely owned by an individual investor or a small group of investors, or publicly owned by a broad group of investors. Now, when we say stocks, we generally refer to the common stocks traded in a stock market. So publicly traded, meaning the ownership is open to public, right? Anybody who buys a stock of a large corporation, generally all the large corporations are traded in the stock exchange, meaning they are publicly traded businesses. Stocks of these companies are traded between individuals, between one stock owner to the next, right, and the next, right. So most companies, large corporations are, as I said, traded in the listed in the stock exchange, and they are traded in the stock market. And when I say they are traded in the stock market, that means secondary market. So what's the secondary market? I probably mentioned this before somewhere along the way, but there are primary market and secondary markets, right? Depending on at what stage of life of the stock, what stage of life the stock is in. Primary market is so like a virgin journey, the first voyage, right? The first time the stock is issued by the company and sold in the market, that's called primary market, right? So in the primary market, the stock is transferred from the issuing company, to the first round of buyers, right? That's the first primary market, and from there on, it's all secondary market, right? Think about it. I buy the first time the stock is sold to the public is called IPO, initial public offering, right? But that's the first time this company ever goes public, right? And after that, there can be public offerings, like a second public offering, third public offering, but they are few and far between, right? It's not like companies can offer stocks every once in a while, right? Once the stocks are issued, then they may, it may take many years before they offer the second round of sale of stocks, right? So primary markets don't exist that often, right? In the life of, the stock doesn't have any maturity, right? So as long as the company doesn't get disbanded, right? As long as the company doesn't stop operating and completely gets disorganized, the stock goes on forever. And in that theoretically infinite life of the stock, there are multiple times of primary market, but it doesn't. What I'm trying to say is it doesn't happen very often, right? Now then, from the primary market, I buy stocks, and then I hold it for about 6 months or 1 year, 2 years, and then I can sell it. When I sell those stocks, if I bought 100 shares of Facebook in the private, Facebook went public in 2012, I believe. And from that primary market, I think 2012, and from that primary market, I bought 100 shares, and then in 2014, I decided to sell that. And then if I sell it, then I sell it to another buyer who's willing to buy it at the market price at that point, right? The second buyer is taking over that stock from me. Of course, we don't have to meet. We don't have to know. It's all arranged by the broker, right? It's totally anonymous. And the second owner can hold the stocks and enjoy capital gains and dividends during his holding periods. And when he feels that it's right time to sell, he will sell. And the third buyer will take over those stocks, and then it keeps going on. It can keep going on any number of rounds, right? N number of rounds, right? And that can be infinite, because as long as the company goes forever, right? So anything after the primary market is then called the secondary market, right? So my sale of stocks to the buyer, that round of transaction, right, is secondary, and the second owner selling it to the third buyer, that's still secondary market. It's all, so after the primary market, all transactions are basically secondary market transactions, right? Now, the companies that haven't gone public, in other words, company that's called private held company, as opposed to publicly held or publicly traded company, publicly owned, publicly traded, publicly held company, right? As opposed to that, privately held or privately owned. And privately held companies are generally small companies or mainly startups. Of course, even a big company can be still privately held. So privately held companies' stocks don't have any market value or market price because they're not traded in the market. But they can be traded between closed circle. I can buy stocks of, and that's called a penny stock. I can buy stock privately held companies, but there's no. It's not a market. It's not done in the stock exchange. It's like if I know someone, right? If I know someone who holds the stock, some stocks of the company, right? Then I can, and if I want to buy that, and he or she wants to sell that, it can be a transaction. That can be a buy and sell, right? Outside the market, right? It's just a private transaction. But again, the price that I paid for that stock outside the market is not exposed. I mean, there's no requirement, right? It's not mandatory to disclose that information. So another private transaction can happen, but nobody knows what was the price in that transaction. Nobody knows nobody else knows what was the price in my transaction. So this is because it is all done outside. Now, of course, for some companies, some small startups, transaction can still happen outside the stock exchange. But just because it is outside the organized stock exchange, right, it doesn't mean that the information is unavailable. It's not always openly available, but sometimes it is not available. Sometimes it is available. Something called, penny stocks. What are penny stocks? Penny stocks are stocks of very low face value. Why? Because these are the stocks of the companies that are not publicly traded. So they are generally small companies, and small startups. And of course, not all the small companies are necessarily risky, but the company that is small because it is relatively very new, think about it, a relatively newly established company is very risky, right? So, and then their shares are practically no way to value their shares because there's no track record. There's no transparent open source financial record, right? So there's no way to correctly value their stocks. But they offer to sell their stocks. Why? Because these companies need to need a lot of capital to finance their operations, finance their R&D. So they are issuing shares of stock and sell it at a very low value, low price. It's not really penny. It's not a prices. Anything a low value like $5, $1. They're all called penny stock. Now, so these are examples of privately owned and closely owned, right, companies, right. Now, stocks pay dividends, right? I've been telling you, right, which is like bond paying interest. But then the difference is, over and over, stock dividends are not an obligation, right? Because it's not borrowed money, right? In case of bond, it's borrowed money, so there's an obligation to pay interest. A stock is ownership, right? You don't owe, as part owner of the company, you don't owe yourself anything. I mean, just the company's management has the obligation. They owe the obligation, right? They have the obligation to give you the maximum return, but that obligation is not enforceable because in all good faith, I mean, think about it. You were trying to do well in all good faith, but some unexpected crisis happened, some unexpected economic shock or not economic shock like pandemic hit the economy. There's no you can't guarantee to pay, so pay back, right? In other words, as you are the owner, you are part owner, right? And as part owner, you are responsible for the result, and the management is held responsible, accountable. But then what can you do? I mean, if you are the majority shareholder, right, you can in the next annual shareholders meeting can move to sack the current management, right? So by vote, you can sack them. But if you are not a majority shareholder, you can't even. I mean, if you're a majority shareholder, you can probably, if you own 51% of the shares, then you can always do whatever you want. But if you are a minority shareholder, there's nothing you can do about it, right? And being an owner, part owner, means that you are prepared to take the result as it is, or I mean, you have no one to blame but yourself, right? So if you are not ready to take the loss, then you shouldn't have invested in that company. And it goes without saying, when you invest, that means when you buy stocks, that means you fully understand you could lose all your money, right? So it's not like they duped you into taking part in the ownership. You voluntarily took part in the ownership, so you have to face the consequences yourself. Now, but the dividend, but once again, so that's why the company doesn't owe you dividend. I mean, company can pay out dividend, but they don't have to. And remember, dividend is coming out of where? Where does the dividend come out of? What does the dividend come out? Remember, the dividend is a portion of the net profit, or EAT, right? So think about it. If a company has a lot of EAT, then they can pay out a portion of that as dividend, right? But if the company is very meager profit, or zero profit, or even negative profit, they cannot pay out dividends, right? So dividend is not an obligation, right? It's not an obligation. Now, interesting thing is, when we say dividend, we mean cash dividend. Dividend is generally paid out in cash, but sometimes they can pay out dividend in additional stocks, additional shares, or they pay out dividends in merchandise. But these two are not what you want. Why? First of all, let's think about it. It's rare, though. It's rare. Suppose they pay out dividends in additional shares. What does that mean? Now, suppose this company has $10 million in stock, common stock, right? $10 million. Let's say the stock price or the book value of the stock at the time the stock was issued, the book value at time zero, right? At the time it was issued was $10, right? That means how many shares were issued? 10 million divided by 10, so that means 1 million shares were issued, right? Makes sense, 1 million shares. Now, and $10 the book value, right? And that was at time zero when the stocks were issued. But then, let's say a year later, if the company has been doing well and if there has been a positive net profit, then you remember the company's the book value will increase by as much as the earnings per share, right? Remember that. And so EAT divided by if the EAT, right, net profit or earnings after taxes is $1 million, right? Then think about it. Earnings per share is 1 million divided by how many shares are outstanding? 1 million. So earnings per share would be $1. Then remember what was the book value per share at time zero is $10. So then book value at the end of time one will be at the end of first year, right? Will go up exactly by earnings per share at time one. So it will be $11 then, right? But again, that's the book value, and market price will be in most cases market price will deviate from the book value in the short run. Why? If the company has a positive company has positively growing profit, then this will be a popular company, right? Everyone will demand this company. So the market price will reflect that demand, and the market price will go up. I mean, even before time one, or even after time one, right? Even after time one, it will become the demand will even higher because now they've seen, right, for a fact that the company's earnings grew by the company's earnings was 10% of the company's EAT is or return on equity is 10% of the equity, right? Return on equity is 10%. So the positive return would and the you verify, the market has verified that the return on equity was 10%. So this fuels more demand. So the market price would go up. I mean, although the book value at the end of year one will be $11, but the market price will be can be higher than that because of the strong demand. Now, suppose so they have now in book value in terms of book value, right? The book value per share is $11, and they have total equity at time one will be $11 million, right? And you understand that $1 million net profit is the equity, additional equity generated by operating activity, right? We talked about this, at in the second topic. So you should this shouldn't be anything new. So that means the equity base, the equity at time one will be $11 million, 10 million from equity at time zero, and 1 million from EAT at time one. So equity at time one will be 11 million, right? Now, remember the original 10 million is called paid-in capital because it's literally paid in by the original shareholders, right? As opposed to this paid-in capital, this $1 million, the equity generated by the operating activity, right? Yeah. So at the end of year one, suppose this company has sold a new round of shares, another this time not 100,000 shares. And thanks to the strong demand, thanks to the positive performance of this company, and thanks to the strong demand, they can sell another 1 million shares. I'm sorry, 1 million. Let's assume another 1 million shares at the book value of at the previous book value of $10. In other words, without hurting the price of the book value of the stock, right? Without altering the book value of the stock at the same book value, right? You can sell another 1 million shares. Then there will be additional $10 million, right? Because you're selling it at $10, right? So in this case, the equity value doubled because thanks to the sale, a new round of another 1 million shares at the book value at time zero. So there are 2 million shares outstanding, and the price is still $10, right? And then total equity, right, at this time will be $20 million, right? And 2 million shares outstanding, right? So therefore, if you divide 20 million by 2 million shares, then still price per share, book value per share will be $10, right? So if that's the case, nobody will complain, right? But suppose, and then because there's an additional paid-in capital of 10 million, right? Additional paid-in capital of 10 million, right? The total equity is 20 million, right? It doesn't dilute the share price. In other words, $20 million divided by 2 million shares, still the book value per share is $10. It's not diluted. It's still the same $10. Nobody would complain if that's the case. But then the problem is, if the company hasn't performed well, right? Then what's going to be the demand for this company's stock? The demand will be weak, right? If the demand is weak, can this sell additional 1 million shares? No, they can't. Why? If they sell additional 1 million shares, there's no guarantee it will sell out, right? Unless it sells out completely and exhaustively, right? At the current price book value of $10, then what does that mean? Only some of those new round of 1 million shares will be sold. And if it is not completely sold, what's going to happen? There is an excess supply of stocks, excess supply of shares, and excess supply means there's something left unsold. And if there's something left unsold, what's going to happen? The price will drop, right? In other words, there was more supply of the stocks than the demand, and the price will have to drop, right? And if the price drops, who gets affected? Who gets affected most and immediately? Of course, the existing shareholders. The existing shareholders will suffer, right? Because as the valuation goes down, then their equity base, investment goes down. So existing shareholders don't like it. They will oppose to a new sale of new shares, right? Unless it is guaranteed that it's not going to drop their valuation of their existing shares, right? So that's why I said companies cannot, after the primary market, there can be another public offering, but it's few and far between, right? Unless they are confident that there's sufficient demand to support the current price, even if the supply increases, and they won't, right?
I understand this may be a little you might feel a little blinded because when I was recording this, I must have used whiteboard, and I was probably writing on the whiteboard. Somehow that whiteboard was not captured on in the recording. So it's mostly verbal explanation. But I guess if you follow, if you listen carefully, it won't be that difficult to follow, right? Why after primary market, after first IPO, initial public offering, companies generally do not issue or sell second round of public offering, right? Because the existing shareholders will most likely it will dilute the stock price, and the existing shareholders won't like it, right? No, I wouldn't like it, and shareholders are basically shareholders have voting rights, right? And if this decision, of course, this decision to sell new shares is made by the management, and if this is the management's decision that is against the best interest of the existing shareholders, obviously the existing shareholders won't uh, uh, will think of firing this current management, right? By voting, right? All right. So let's continue.
That is the reason for. That explains why stock price dilution happens, right? But think about it. paying dividend in additional shares is just like selling new shares that is not supported by the demand. If it is not supported by demand, price falls. So, and this time, if you're paying dividend in additional shares, this is not even sale of new shares. So that means there's no demand buying it, right? But you just simply, let's say for every 100 shares, they are paying one additional share as dividend, right? So that's 1%. So what did I say? This company in our example has $10 million in equity, and which is represented by 1 million shares outstanding, because the price is $10 per share. So if you increase, if you pay dividends in shares, additional shares, what does that mean? 1% additional shares, and because you're getting one additional share for each 100 share you have, then there will be 1% more shares outstanding without any paid-in capital to support it, right? In other words, there will be 1,010,000 shares outstanding with the same unchanged original equity at time zero, right? Which is $10 million. What does that mean? You are dividing $10 million by not 1 million shares anymore, but by 1,010,000 shares. Now, obviously, then the share price will be diluted. You got your, let's say you had 100 shares, so you got one additional share. They paid, you got one additional share as dividend, but this is, you might, so I have 101 shares now. Should you be, can you be happy about it? Of course, anybody sensible won't be happy about it, right? Makes sense, because your equity, total equity value is still the same. You just divide it by additional shares, right? Then obviously the fraction will be smaller, which means the market price of the price will go down, right? Price will be small, right? So that's why dividend in additional stocks are not favored, okay? And paying dividend in merchandise, this is also this is ridiculous. Usually, if they do, they are trying to unload their unsold inventory. If it is unsold inventory, then that means you're stuck with the unsold inventory that you have to liquidate. Obviously, it's not one of the. This is not of the favored solution, right? The favored method of getting the dividend. So anyway, so the question is then what is the preferred stock? Okay, we understand what preferred stocks. Preferred stock is often considered, quasi-debt, almost debt, because much like interest on the debt, preferred stock pays fixed periodic dividends, right? So remember, dividend depends on the profit, right? Because a fraction of the profit is being paid out as dividend. So if the profit goes up, dividend will go up. Profit goes down, dividend will go down. Because if the dividend payout ratio, right, the percentage of the profit that is being paid as dividend, let's say it's 10%, right? If the dividend payout ratio is 10%. Now, if the company's net profit is $1 million, right? 10% of 1 million is 100,000. But if the company's net profit is 2 million, right? 10% of that will be 200,000. So dividend changes with the profit level, but that's for the common stock. For preferred stock, regardless of the company's profit level, you will always get the same dividend, constant dividend on the preferred stock. Now, if you're getting a constant dividend, it looks pretty much like annuity, isn't it right? Isn't it right? Right? Because annuity is a constant amount paid at regular interval. So this is the constant amount, and it is paid at regular interval. In case of quarterly, right? In case of stocks, remember, dividends are paid quarterly. So it's a regular constant amount paid at regular interval. So that's an annuity. But then the difference between that's the similarity. That's the similarity with the bond. But the difference is bonds have maturity, right? There's an end point. But stocks don't have maturity. Stocks go on forever. So there's no end point, right? So what do we call such a thing? It's called perpetuity, right? Perpetuity is like annuity, going on forever, right? And it's less risky than common stock. Why? Because common stocks cannot pay any dividend, right? Before it pays dividend to the preferred shareholders. So as I said, if the company didn't make any profit or even made loss, there's no way to pay out dividends. So that means that also includes preferred stock, because anyway, the source of dividend payment is coming out of the profit, right? So if the profit is zero, there is no way you can pay dividend, common or preferred. Okay, but let's say the company is doing better and they net profit, so they can pay out dividend, but they will have to pay out first to the preferred stock, and if there's money left over, then they can pay out to the common stockholders, right? So for that reason, preferred stock is less risky than the common stock. Okay. So as I said, they will have if they don't have any money to pay out dividends, then they will have to skip the dividend. For preferred stocks, there are two types depending on what they do with this skipped or passed up dividends. Now there are two types. One is cumulative, and the other one is non-cumulative. Cumulative preferred stock pays dividend in arrears, right? The dividends that have accumulated while it's skipping, right, or passing up the dividends, right? So if it is a cumulative preferred stock, they will pay all the accumulated dividends, right, held in arrears before they pay the dividend for the current quarter, or so anyway, that's cumulative. And non-cumulative preferred stock means the dividends, the past dividends or the skip dividends are not paid, right? They are just simply gone, just like common stock, right? Either way, the common stock cannot be paid until preferred stock dividends are paid first. Okay. Now some preferred stocks have call feature, just like the callable bonds. They also have conversion feature, converting to common stock, right? Some of them, right? Okay, that pretty much sums up everything about the preferred stock. Now, what's interesting in the stock is IPO, going public, because a lot of high-tech startups are they started out originally as a privately held company, and then they get funding from the venture capital to grow. And then once they have met certain requirements, then they go public, meaning selling stocks and stuff. And when there's this IPO, initial public offering, when it happens, then it can be a chance for tenfold, even tenfold return, right? Why? Because when it was privately held, there's no the price is just book value, right? And then if this company has racked up sufficient reputation and positive reputation, right? When it goes public, right? All that positive expectations would explode in the pent-up demand will explode, right? And then the price will shoot up like crazy. And at that point, if you were one of the original founding members or stockholders when it was privately held, then you gain, right? You see overnight. Of course, the value is just the paper gain, right? Until you sell, it's the paper gain. So think about it. Let's say I was holding 2,000 shares. 2,000 shares of a company called Moderna. Moderna, or Moderna is but it's already public, right? But let's say a company called X is a company in pharmaceutical that is developing a COVID-19 vaccine, and this company is not public yet; it's private, and I'm one of those original shareholders. And book value was just $10 per share. So I was holding 2,000 shares, and so that means $20,000 in book value. And let's say this company is currently pending the FDA approval for the vaccine, and let's say the vaccine is finally approved by the FDA, and then they go public. What's going to happen to their stock price? Their stock price will explode, right? And I, having 1,000 shares, which was $10 per share, right? And I have $20,000 in this, in terms of in this stock. Now on the IPO day, it jumped from $10 to $100. That's a tenfold, right? Tenfold is what? About 1,000%, right? Actually, the return will be 900%, because actually from $10 to $100, right? The growth portion alone is only $90, right? But anyway, if that happens, my valuation will be now from $20,000 to $200,000, right? And if I sell right away, then I realize that gain, right? I realize the return. But if you don't sell, it's just paper gain, right? But anyway, the idea is that's why IPO is so hot. Everyone wants to jump in on this bandwagon, and everyone wants to have a piece of it. But then it's not like everyone can jump in. Why? IPO is strictly on invitation basis. Invitational. It's not like you can buy. Strictly invitational, and then who gets invited then? Of course, institutional investors. Majority big, who is invited? The brokerages. Brokerage firms invite then they will invite their major clients who have like $1 million, in at least something like that, $500,000 plus, right? And those as individual investors, if you have like $1 million with a brokerage firm in your account in the brokerage firm, that is a very wealthy individual investor. For institutional investors, of course, it's a piece of it's a peanut, right? But anyway, so only select few individuals. If you're one of those who bought those shares at IPO price, and then within the day, the price jumped, market price jumped. IPO price was, let's say, $50, and the price jumped to $500 in a matter of a week, right? You buy it at 50 and you sell it at 500. You realize really 1,000%, a 900% gain, right? But again, since generally, small account individual clients are not invited. Generally not invited. The first time you can lay your hand on it is in the secondary market, not in the primary market, right? So IPO stands for initial public offering, as I said, and I told you public offerings, there isn't only initial public IPO, there's second public offering, third public offering, right? But second and third public offerings will come later when the company is more mature than startup, just a startup. And if they do, they will need to have a proper justification, right? In other words, they will need to have the justification to support, to have enough demand to support the share of new shares, right? Sale of new shares, right? Otherwise, it's totally, it could, it will only dilute the share price, right? Now, I'm trying to. So let me quickly check. And other than public offering, there's something called rights offering, and rights offering means what? Instead of make a public offering, if they need to raise new capital, additional capital for, let's say, $10 million, right? Then they will, of course, they will issue new shares, but they offer it to the existing shareholders first, right? I mean, if it is, and if the existing shareholders, especially if it is a relatively small number of additional shares, right? Existing shareholders are holding their stocks because they are more optimistic about this company. So the chances of completing exhaustively the sale of new shares is more feasible, right? You can exhausting all the shares in sale completely is very important, because once again, remember, if you issued new additional 1 million shares and these 1 million shares fail to sell completely, in other words, it doesn't 1 million shares don't exhaust, right? Don't get exhausted, then don't sell exhaustively, right? There's something left over, right? That's going to dilute the stock market price of the stock, right? So if they don't want to risk that chance of stock price dilution, they would first offer it to the existing shareholders, right? And there's a better chance of, and then the third one is a private placement. Private placement is only contacting large institutional investors, because they are institutional investors. They command more capital, right? They can mobilize also. They can mobilize a lot of capital, and they can relatively easily, if for example, a small scale, right, on a relatively smaller scale, if they are raising new equity capital on a relatively more small scale, 5 million, 10 million, 20 million, right? By contacting and negotiating with the prospective candidate who can, and institutional investors like insurance companies, they have huge cash holdings that they need to invest. You can easily cut out a deal, and you can exhaust like a tailored deal, and you can sell 1 million shares and for $10 each, and you can easily raise $10 million from a particular individual institutional investor. It's a private placement, so they risk little. I mean, the company issuing new shares will be facing less risk of failure to sell, risk of failing to sell exhaustively all the shares, right? Now, we need a little more time on IPO because the process and the parties involved. This will require more time to discuss, and we are right now simply we're almost out of time. So
this first video ran out, but we always have the second video. So let's move on to the part 2. Okay, stock valuation part 2. It's going to become more interesting from actually part 3. Okay, so let's take a listen.
Hello, welcome back, and we are continuing our discussion about IPO. So in our last class, we started on this discussion. We briefly defined, IPO and what other ways of raising capital, equity capital, what other ways are there. And IPO is just, a kind of a public offering. And then other than that, there's rights offering. We talked about it, and also private placement. We are mostly interested in the IPO, so we're going to be talking about the procedure. Okay, so IPOs are typically made by small, fast-growing companies that either require additional capital to continue expanding, or have met a milestone for going public that was established in the contract to obtain venture capital funding. So here's a new term, venture capital. And of course, venture capital is sometimes also called, angels. I mean, it's just a metaphor. I mean, like black swan, or fallen angels, all these things. I find it quite the last remaining. I find it to be a last remaining trench of humor for the finance people, because, well, labeling this, I mean, that's quite literary, and but the metaphors are, in a way, a good analogy or allegory based on the culture of the society. For example, using the term like fallen angels, and we talked about it. Fallen angels are like below BBB class bonds, right, in terms of risk, right? But think about it. That's like biblical, right? Fallen angels, fallen from grace, right? Or black swan is like the Tchaikovsky ballet, where the brothers are, or the Swan Lake, in Swan Lake, other than the princess, all her brothers, princes, turn into black swans or something like that, right? And then black swans are like harbinger of bad luck or disaster, or But anyway, angels, in the same, because it's pretty much in the same context, right? For example, a startup who desperately need capital. Uh, the startups generally are, have technology, or have some innovative ideas, but they just they don't have capital. That's usually the case, right? I mean, let's take Facebook as an example. Usually these days, startups are high techs, right? So high tech comes out of the people who have science and technology or engineering background. Because of course, well, where else can it come out of? Can it come out of English literature or philosophy? Can it come out? Any new business will have to be based on the technology that can be that have a novel or innovative potential for market, right? And of course, then that would have to be that would have to come from science and technology, science, technology, and engineering, right? So these people are like have that great idea, great new innovative idea, in terms of technology, right? So they form a company. All the high tech started out as a from small, from their parents' garage. Like Bill Gates, Microsoft, started building computers from his father's garage, and also Steve Jobs and Steve Wozniak. Steve Wozniak, Steve Jobs. They also started building computers from Steve Jobs' parents' garage, and Michael Dell, or the same thing, So Facebook also started out as a college dorm project, right, at Harvard. So these kids, at their, when they are in college still, so they start up a first it was a college dorm project, but then they saw business potential in the social network platform. And then the venture capital spotted them. They saw potential, so they offered to invest, let's say like $5 million, right? For college kids, just operating based on a small scale, social network program. And obviously, they didn't have any capital to grow this into a big business, right? And to grow this into a big business, they should have a business model that is viable and self-sustaining and viable. And then you have to reach out to a large audience, and then you cannot do it from your just personal computer or laptop. You have to have a server that can handle more traffic, bigger storage capacity, and anyway. So they need basically to grow their business, they need equipment, they need investment for the capital equipment. And then the venture capital spotted them, came around and offered to invest, let's say $5 million, right? In return, all they ask for is let's say 1 million shares, right, for example. And think about it, if they get the investment of equity investment of 5 million and issue 1 million for that, then the price per share is simply $5, right? Makes sense. And then at this point, think about it. At this point, this company has is not in the market, right? Facebook is not even a company that is listed in the market, accepted in the market, and trading in the market, right? It's just still yet just a startup, and privately held companies, held privately by the venture capital and by Mark Zuckerberg and a couple of friends who are original founding members, right? So let's say 5 million is just a number, just fictitious number, $5 million. And if they issue 1 million shares, right? Let's say these 1 million shares are held, between, of course, held between these, venture capital and Mark Zuckerberg and a couple of other founding members. So, of course, the largest proportion goes to, let's say, probably 99%, 95% goes to the venture capital, because they are the one that actually invested substantial amount of capital, right? And since Zuckerberg and his friends are founding members, they also keep some number of shares. But at this point, since their stock is not traded in the market, right? It's simply their stock is only honored between the in this private group only honored by them, right? So at this point, it's only book value, right? Book value is simply the paid-in capital divided by number of shares. But the venture capital, the whole purpose of the venture capital is when they take it to IPO, right? Then the price, they are basically expecting the IPO price will be at least $50. If it is $50 at least, then that's already 1,000%. I mean, to be exact, it's going to be 900% return because it's from $5 to $50, right? And that's the only reason that the venture capital is investing $5 million into this company, right? And then, of course, there are certain steps and procedures. This company must meet the preset milestones, like in year one. By the end of year one, you reach 1 million users, right? 1 million subscribers or 1 million users. By the end of year two, you reach 10 million users, and so on. And by year three, 100 million users, and at least $1 million in advertising. Web pages have basically their source of revenue is advertising, right? Pop-up banners and things like that, right? Banner ads. So year four, and then another milestone, right? And if they have all met these milestones, right? And then by year five, and then meet another milestone, and then finally, if they have all met all these milestones, then it's ready to take the business public. So that's what the venture capital is looking for, right? They are aiming at taking this company public and then make huge return out of that IPO. So but to go to take it public, then they cannot do it by themselves. They need a broker, right, for IPO. That is the broker role is assumed by an investment bank. They will have to hire an investment bank, right? So the investment bank is the functioning like the intermediary in going public, right? So you remember at the beginning I told you that there is there are largely two branches of banking, right? Investment banking and commercial banking, right? Or retail banking. And I said the regulatory agencies are different. For commercial banking, it's the Federal Reserve, and I said for investment banking, it's the SEC, Securities Exchange Commission. And commercial banking or retail banking is basically what you generally what you understand as banking. They take deposits from the savers and make a loan to potential borrowers, right? And lend money for home mortgage and car financing and things like that. That's what the commercial banking or retail banking is doing. And investment banking is mainly what they are doing is brokering or intermediating the IPO and investment and then also management consulting, things. Those are what the investment banks do, and asset management as well. Now, but prior to, there was there was a time when investment banking and commercial banking were separate. They were completely segregated or separated. This because of the great stock market crash and ensuing Great Depression of the 1930s. Why? Well, prior to the stock market crash of 1929, they had there was no clear distinction between commercial banking and investment banking, but that caused the problem because all the commercial banks also took their depositors' money, right, savings, without remember Federal Deposit Insurance Corporation (FDIC) and the fractional reserve fractional banking or reserve ratio. Remember that that was discussed already a long time ago, right? When we were talking about the ROI, right? But fractional reserve banking means you cannot use you cannot invest all of the money in the checking account, right? Remember, banks are tempted. They're tempted to invest all the money they have in the bank, but that's depositors' money, right? But the bank. I told you the business of bank is in lending, right? They make money by lending. They don't make money by taking deposits. But what they lend or invest comes from the depositors. In other words, they are playing fire with their clients' money, right? They're playing with fire, right, with their clients' money. So that's basically a very risky thing, right? Of course, if they are making only safe lendings, or like buying bonds of like AAA, AA, single A companies, right? The risk is very quite minimized, but the bank is tempted to increase, to take more risk, right? Because the bond return from the bond is very meager compared to the returns from the stocks. So they are more tempted to put money, invest that money in stocks. But I told you, I mean, their own equity, banks' own equity. Remember, we looked at the banks, like a very rudimentary structure of their balance sheet, and of course, all the sources of capital for them is also debt and equity. Equity is basically the bank's startup capital, right? So but it's their own capital. They can invest up to 100% of that into a very risky investment, very risky asset, because it's their own money. If they lose that, they only have themselves to blame. But it is not right to play with the depositors' money. What I'm saying is, play risky games, right? Now, deposits in the savings account, it can be loaned out. I mean, long term, or even invested, relatively risky assets, because the money in the savings account is basically tied up for a long term. So you cannot. It's not a demand deposit. You cannot demand. Of course, if you want to take your money out, yes, you can. But generally, you are not. The idea of savings account is that you are not withdrawing money very frequently, right? And as long as they can use that money for long term without worrying about getting that funds withdrawn, every day, right? Then even if they make some losses with that investment, in the long run, if they can recover it, let's take when you your CDs, right? By then they will have money ready, because it's always in flux. There is deposit coming in every day, right? Investments being made, cash outflow made every day. It's in the flux. Now, well, once again, savings, the money in the savings account, they can make a long-term investment with that. But I told you, the money in the checking account, they cannot use that 100%, invest 100% of that into any investment, because money in the checking account is a demand deposit, meaning it can be there should be money ready to give out when the customer comes to withdraw the money, right? So reserve ratio is the literally the ratio of that checking account that must be constantly held in the bank, right? Now, even that's also called fractional banking, right? Even that was not in place prior to 1929. And so think about it. In those days, the banks were, as I said, all tempted to make use all that money into a stock market. And then the problem happened, right? The stock market crashed, and they have there's no minimum reserve that is held within the bank, right? The money, all the customers' money, depositors' money was all put into the stock market, and the stock market crashed in 1929. So what happened? With the news of the stock market crash, all the depositors ran to the bank to withdraw their money. The bank had no money, so a lot of banks went bankrupt, right? So that was the reason for FDIC, Federal Deposit Insurance Corporation. And FDIC is I told you, deposit insurance, insurance for your deposit. So now at least you are covered up to $250,000. But in those days, there wasn't even that. No fractional reserve banking, no FDIC. So what? Everybody lost all their savings. That's what caused the outbreak of the Great Depression, right? So after that, what came from that experience? So FDIC came about, and fractional reserve banking came about. What else? The separation between investment banking and commercial banking, which was enacted by the law called Glass-Steagall Act. So if I'm not, because it's an institutional side, and I'm not an institutional person, I'm more into a math person. So, but anyway, in the U.S. banking history, hence the separation of investment banking and commercial banking. But that Glass-Steagall was act was revoked, repealed, right? It was in like 1989, I believe, that Glass-Steagall was 1999, sometime around like 1999, that the Glass-Steagall was revoked, and that was sadly that was during the time of Bill Clinton's administration. I mean, it's not Bill Clinton who pushed for that. It's the Congress that pushed for that, right? Repealing, So, but then the president has to sign that. So Bill Clinton signed it. But then that means the end of separation between commercial banking and investment bank. What happened? So then there was no more. The line has blurred. Already over the years. So there's no more distinction. So commercial banks were even able to act as a encroaching into the realm of the investment banking. But that means what? More banks are becoming more prone to risk. I mean, more banks are readily willing to take more risk, and then what? 2007, finally, right? Financial crisis again, right? Once you repeal that regulation, right, regulatory measure, then it's again mayhem. It's again a total disaster. Of course, the first thing that happened was a subprime mortgage crisis, and its subprime mortgage crisis was all possible because the Glass-Steagall Act was repealed, right? And the banks were able to make this or participate in this mortgage-backed securities that eventually exploded. So regulation is really, 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 really crucial, essentially, because the banks are by nature, right? Banks are prone to take more and more risk because the bigger the risk, the bigger the chances of higher return. The higher return means higher compensation for the bank's management, right? But then think about it: they're not playing with their own money; they're playing with the client's money, bank customers' money, right? This is and then even from George W. Bush administration, there has been a lot of attempts to even privatize the Social Security. And what does that mean? There's not going to be government protected, guaranteed Social Security. All these Social Security funds will be managed by profit-seeking private portfolio managers. And then what? If your money is entrusted with a portfolio manager, that means you're agreeing, right? You're agreeing to give them the full power to do anything with their money, but they're not taking any responsibility or accountability. I mean, if they lose all your money, because knowing the risk, I mean, it's basically understanding is if you are letting them handle your money, you're giving them a consent to play with fire, right? So then they are not being held accountable. You will be responsible for that result because you gave them a consent. And this is the downside of deregulation. They praise as if deregulation is freedom. Economic freedom. Freedom is not. You think freedom is a wonderful word? It's a wonderful word if it is true to its real meaning. But they use the word freedom as a cliche. It's a cliche, right? It's like of course you have a freedom to be stupid. You have freedom to die. You have freedom to do anything. Go out and without any masks and without any protective gear, surgical gloves, or whatever, with no hand sanitizer, no alcohol, hand sanitizer, alcohol-based hand sanitizer, touch anything, mingle up with a lot of people, exposing yourself to their droplets. All these things, you have a freedom to do that. In other words, that means you have a freedom to be stupid. What is that? Then think about it. You have a freedom to be stupid, but also you have the freedom to be sensible. Or I mean, it's not freedom. It's the you have the responsibility to be sensible, right? So the deregulation was a big, word that the Republicans, or Trump administration or any Republican administration like to use, because they always want to privatize the Social Security. Why? Because the financial industry, the Wall Street, is all right. They have lobbyists. They are lobbying the Congress, especially the GOP, the Republicans. And they corrupt. Lobbyists are basically cancers. They corrupt the politicians. And the Wall Street and the 1%, wealthy, top 1% wealthy, large corporations, they hire the army of lobbyists, and through lobbyists, they pay these politicians, they bribe these politicians, that's what corrupts. Money corrupts the politics, and left and right. I mean, it's not the part. There's no meaning in party line. I mean, Democrats are also taking money from the lobbyists. Republicans more taking money from the law, because Republicans are basically the ideological platform of the Republicans are very well aligned with the large corporations, right? Or the wealthy. They want small government. What does small government mean? Small government means a small government budget. To have small government budget, what do you have to do? You have to slash all the government functions, government expenditures. Like why are we having this crisis? In the middle of the pandemic, the medical professionals are lacking even the most basic protective gears, right? No mask, no surgical gloves, no protective like lab clothes, no protective gowns, what they call PP. Why? This is something that has to come from the public funding, right? Like CDs, because it's not like pandemic happens every day, right? It's not like private hospitals, private medical practices always have these medical infrastructure, like ventilators and things like that. So who should be, because it's not happening every day. If it is happening every day, they will all have it. But then it's like a war doesn't break out every day, but the country has to maintain a decent level of military force, right? Military forces to be the war. The war breaking out is like the probability. The odds of war breaking out is very low. Let's say it's not like at a trigger point. But even for that 1% probability, or even for that 0.1% probability, that's why we have to maintain a large military, right? If you think military is a waste of money, public money, and military is basically funded by the taxpayers' money, right? Tax revenue, and there's no war going on. Why do we have? But if you slash the military and something happens, even you won't be prepared for that. And also but that's what the Republicans are favoring. Small government. Small government means CDC is a waste. We're not having a pandemic every day, so all these budgets for CDC research, pandemic research, and preparation for something like this is all waste of taxpayers' money. So they slashed the budget. What about EPA, Environmental Protection Agency? They slashed the budget for a lot, because environmental EPA has been publishing reports against all these giant corporations that are polluting the environment. And so these giant corporations, coal, oil industry, or whatever, because mining industry, they use the lobbyists. They send lobbyists to the Washington D.C. and make contribution, political contribution, donations, to these corrupt congressmen, senators, mostly GOP Republicans, Mitch McConnell, Lindsey Graham. All these people are not the people's politicians, but they are politicians for the big businesses. NRA, gun lobbyists, But then think about it.
Okay, the list goes on and on. The list goes on and on. However, we'll have to put it on a pause because the time is 7:15 already. So we'll take a 10-minute break and reconvene at 7:25. Okay.
Professor, Professor,
Thank you.
the question after the break.
Yeah. Or you can just listen. If you have a question, type into the chat box,
You
please.
see, where's the chat? That's the whole thing. Where's the chat box? I didn't see. I see written. I didn't see
You
the.
haven't explored? You haven't explored? Look,
Where's the chat box?
It's the little purple tab at the bottom right corner.
The little purple box.
look,
Uh, where's the little?
the balloon, right?
Can, where?
You see the screen? Do you see the screen?
Yes, I saw
Um,
the screen.
and I'm pointing at it.
Oh,
I'm
oh, oh,
pointing
yes.
at it
Oh,
constantly,
sorry.
right?
Hold on, the chat box. Hold on.
Okay, so 10 minutes. All right, we're back. We're back. Um, so,
Professor, I still want to add a question, please.
yeah. Go
What is
ahead.
the relationship between IPO and venture capital? Can you clarify that one more time, please?
Oh,
What is the relationship
relationship between
between
IPO
IPO
and the
and
venture
venture
capital.
capital?
Yeah. Well, basically, venture capital is the funder. I mean, venture capital provides capital to the startup, and basically, if the venture capital invests like $5 million into this startup, they want to recover this, but they don't want to recover just 5 million. They want to recover a multiple of that, something like 100%, 200%, 300%, and this can happen. This can happen through the IPO, because if this startup is deemed as a very positive, promising company, right? And at IPO, I mean, currently, if venture capital has invested 5 million and in return asked for 1 million shares, and so 1 million shares were printed and were issued to this venture capital, and the face value of, or the par value, or book value of that stock is $5 per share. But once again, this is only par value or book value, because there's no market, it's not in the market yet, so there's no market price. Now, IPO is the first time they are introduced to the market. So if this company is deemed very, promising company, then at IPO, this price will shoot up. And if it shoots up like, even 100%, then, the venture capital will sell all their 1 million shares. Or they may retain 10% of it or 20% of it, depending on, what they decide. But basically, if they unloaded all those 1 million shares, obviously they are selling them for $10 now at IPO.
So that means that
And
so that means
they're
that the
making
investor,
100% return. Say
I
that
got
again.
you. So in other words, investors, when they agree to give the startup companies a certain amount of venture capitals, they can propose, if I let you have this dollar amount of VC, I want to have a number of IPO shares in return when your company, when the startup is ready to go for IPO, meaning that they already have an agreement before any IPO goes to the public. Is that correct?
I couldn't quite make out what you were saying because there's an echo. But from what I gather, yeah, you are close. I mean, you are basically, the shares are issued already when the venture capital provides the fund to this company. You don't give up $5 million without receiving anything. Isn't that right? You don't give up $5 million basically, without receiving something that proves that they have a stake in this company. And that's the shares. That's the stock. The stake in the company is represented by there's 1 million shares of stock, right? And this stock is not traded in the market yet, right? But once the stock starts to get traded in the market, which is through the IPO, then if the stock price goes up to like $10 at IPO, the venture capital can sell them and then recoup the principal with 100% return. And
Okay, I
that's
understand. Thank you. I
yeah.
understand now.
Wing, yeah. The next time, please. I don't know why, but there is an echo when you are speaking. So there must be some audio device or some something that is making that echo near your computer. So I think it's important. I think you should turn it off first, right?
Sorry about that.
To prevent that echo, right? All righty. So let's, if there are no further questions, let's pick it up from where we left off. Okay.
A lot, but what I'm talking about is the line between investment banking and the commercial banking have been blurred, and that's after the repealing of Glass-Steagall Act in 1999, and then after about 8 years after, 8-9 years after repealing of Glass-Steagall Act, the financial market is in complete disarray, chaos, and then what happened following that was the subprime mortgage crisis, and then financial crisis, and then you see 10 years after that, COVID-19. Why? Because CDC is minimalized. CDC is all these functions that the public health infrastructure, all the functions of CDC that would manage and oversee the public health infrastructure have then all their budgets have been cut, their functions have been gouged out, and all. So what? We're in the middle of the a crisis again. Economic crisis, financial crisis caused by public health crisis. You understand? That's why the corrupt politicians are worse than the coronavirus. So anyway, investment banking that brings us back to the investment banking. Investment banking is what investment banks are basically taking, like intermediating or brokering the IPO, and they do this through a process called underwriting. What's an underwriting? I mean, once again, some people may understand what underwriting is. If you look up the dictionary, it's like guaranteeing something. Well, that semantics dictionary, meaning the semantics is very limited. Why? It is not used in the correct context. That's just a general meaning of the word. But when you say underwrite, literally, where would you underwrite? Someone signs a document, like a contract or agreement. Someone signs it, and you write underneath that signature. That's why you're like a co-signer. That's why it's called underwriting, isn't it right? But if you're co-signing a contract, what does that mean? You are guaranteeing that person who is the principal signatory of that contract, right? But that is the general meaning. What does it mean exactly in the context of IPO? Well, underwriting means actually. Let's take a look at this. Underwriting is like investment banks buying the IPO shares from the issuing company. Okay, so let's think about it. So Facebook is now going public, right? First, their IPO, and of course, before IPO, the investment bank and the issuing company discuss what will be the most maximum possible capital they can raise, and what is the most possible selling price. What is the realistic marketable price? And based on that, okay, so if potentially Facebook can raise $50 billion or 10, let's just make it $50 billion. $10 billion. Let's make it easier to work with. $10 billion out of this. Then how much should the price be? How much should the par value? I told you in stock, par value is the initial, right? IPO price is the par value. What should be the par value? Is $1,000 par value doable? No, it's not doable. So then what should it be? $100, maybe $100. Okay, let's say 100, because if it is $1,000, it's not marketable. It lowers the marketability. But if it is like $100, it seems reasonable. Okay, if the par value is $100, then issuing price, initial price is $100. Then to raise $10 billion, how many shares to issue? Of course, 10 billion divided by 100, right? So that will be 100 million shares. So they will print 100 million. I told you, printing and administrative floating the stocks, floating is called floating. I told you flotation, right? Printing the stocks and making announcement, and they have something called roadshow before IPO. It's roadshow is like public relations stunt. So they decided to issue 100 million shares at $400 per share. Then if you multiply them, that's going to be if things go well, and if things go well as planned, then $100 times 100 million will be $10 billion. Okay, but now next question: is there any guarantee that all those 100 million shares will sell? Is there any guarantee? Well, the investment bank has counseled the issuing company, so this number would be a feasible number. I mean, it would be a realistic number. I mean, if it is really just a far-fetched number, there's no reason for using a. How can investment bank be likely a feasible number? But there's no guarantee, 100% guarantee it will all sell. What if it flops? I mean, more recently, like early this year, I guess, or late last year, there was a failure of an IPO of a company called WeWork. I don't know if you've ever heard of that company. It's it's an office sharing platform, right? Like what's that called? You travel. Just it's at the tip of my tongue, but if you travel instead of Airbnb, right? Just like Airbnb, this is for car sharing platform like Uber, right? WeWork is an office sharing platform, and it's public, right? But it was a total disaster. For example, let's say 100 million shares, not even half. I don't know what exactly got sold, but not even half. So it was a total disaster, right? But it's not like they didn't use higher investment bank. I mean, they must have, the investment bank advised them to, this is the potentially maximum capital you can raise. The price this would be a marketable price, etc., etc. But still, it flopped. Still, it failed, right? And then the venture capital will lose a lot of money, right? So this is the thing. I mean, although the investment bank says this is doable, but there's no 100% guarantee. So from the issuing firm, right? What guarantee? It doesn't have any guarantee. Usually, it's like hiring a lawyer. When you hire a lawyer, is there a guarantee that they will win and you will win the case? All they say is that I'll do my best. We'll do our best. There's no guarantee, but we'll do our best. It's called best effort agreement. And then if you lose, then they don't pay you back any. You have to write a retainer. Retainer is basically a contract to hire a lawyer, and you pay a lot of money. And even if they lose the case, they don't return you the money. They just keep the money. You are stuck with the result of the lawsuit. And if you lost, then you will have to bear the cost of the lawsuit. Right? This is ridiculous, right? But that's what it is. That's the best effort agreement. But at least in investment banking, in IPO, there's something better. It's called underwriting. What's an underwriting? Instead of best effort agreement, the investment bank offers the issuing firm the certain amount of that proposed, that target $10 billion. For example, they will say, okay, instead we'll pay you, since there's no guarantee that it will sell, we'll buy all of your shares, but we'll buy those shares at $70 per share, not $100 per share. Okay, so if they pay $70 per share, then the capital that you will raise won't be $10 billion, but just $7 billion, right? But doesn't matter. And from the issuing firm's standpoint, this is anyway $7 billion in plus, right? You were without any $7 billion, right, prior to IPO, but after IPO, suddenly there's $7 billion. The company can use this money, right, to do whatever it wants to. They will mainly use it for, expansion of the, they will build a plant, or they will, expand their production capacity, etc. So then, what does the investment bank do with that, 100 million shares? With these 100 million shares, then they sell it at $100 per share. So if they sell all of those 100 million shares, then they will, the revenues from sale of those all the shares is 10 billion. They already paid you 7 billion, so 3 billion is their cut. They make 3 billion, and this 3 billion is called underwriting discount. Underwriting discount. Okay, so that's the reason for the investment bank to be in business. They, by underwriting, brokering and underwriting an IPO, they make huge money. Of course, if they successfully sell all 100 million shares. Okay, but even if not, if they didn't sell all 100 million shares, still they would make probably 1 billion or 2 billion, or if lucky 3 billion, right? So that's called underwriting. But in underwriting, right, it's not just one investment bank that is involved. It's a network. It's a network or syndicate, a network of investment banks and brokerage firms, which form an underwriting syndicate. An underwriting syndicate is something like this. So there is an issuing corporation that is in IPO, right? That is floating on IPO, and then they originally contact. There's an investment bank that they originally started to work with. That's called originating house. So, for example, they chose to work with J.P. Morgan, right? And then J.P. Morgan will form a syndicate with other investment banks like Merrill Lynch or Goldman Sachs and other investment banks. And under each investment bank, there are several selling groups. Selling groups are generally like a brokerage firms. Well, think about it. When you buy stocks, you will have to open an account with a brokerage house, right? You will have to open an account, and the brokerage houses usually also subdivisions of the investment banks. The brokerage houses are at the front line. Brokerage houses are actually at the front line of interface with the clients, with the actual investors, like individual investors. If you are very wealthy and you have like $10 million, what do you do with it? Of course, some of it is in the bank, or if all of your money is in the bank, you don't just keep it in a savings account. The bank will offer you, basically, you have $10 million in the bank will offer you personal banking service. Personal banking, through the personal banking, they offer you a fund manager, portfolio manager, the bank. But if you're managing, if you have like $10 million, you will put some of it in the you'll open a brokerage account and put the money in the brokerage account, and you buy stocks, bonds, from that brokerage account. So the brokerage houses are at the forefront of interfacing with the clients, right? So the more the brokerage houses are involved in this IPO syndicate, the more likely exposure they will have with the clients. So the more clients, the more likely to succeed, right? There's a more likelihood of success in this IPO, right? Think about it. It's better than more investment banks have more working relationships with the brokerage firms, right? More connection, more related, more connected with the brokerage firms, and the more brokerage firms will be connected with more clients. So the chances of successful IPO increases, right? That's called underwriting. Okay, so that brings us to the conclusion of the institutional side of the stock market. But this is not institutional aspect, as I said, is not the main thing we want to do, because, as I said before, I'm not an institutional person. I'm more into the mathematical aspects, mathematical modeling of the especially financial market, especially the asset valuation. So the time is almost up, so we will continue with the stock valuation models in the next class. Okay. Today,
Okay, so the next video, right? We're finally getting started on the valuation part, right? Okay. I don't think we can finish this video today, but whatever we can cover, and then whatever is left, that will be tomorrow, right? Let's get started.
Lecture is stock valuation. So continuing from our last lecture, last video was about the IPO, right? So at the time I said, as we wrapped up that video, I said, this is the end of the institutional aspect of stock valuation. And then from the next lecture, we're going to be on the strictly on the mathematical aspect of stock valuation. So we're starting with the 4 stock valuation models. There are 4 stock valuation, namely, I mean, other people may not, or other textbooks may not classify this as 4, but I put them into 4 categories, right? The 4th one is not shown on this slide, but namely, these methods are called DDM. And what does DDM stand for? It stands for dividend discount model. Okay, so stock valuation models are a part of a larger group called DCF. Okay, DDM is part of a larger group of valuation models called DCF. What does it stand for? DCF stands for discounted cash flow models. Discounted cash flow models. Okay, so if you think about it, discounted cash flow model is not something new. If you think about it, bond valuation model was basically a discounted cash flow model. Okay, why? Let's take a look. Let's go back to the whiteboard. But before we go to whiteboard, let's take a look at these models. 3 models first. The first one is called constant dividend model or zero growth model. Okay, constant dividend means constant is dividend. Dividend is constant, right? Dividend doesn't change; it's constant, always the same. Okay, that means dividend is not growing at all, or growing at 0% rate. Okay, and it's called zero growth, right? The next model is called constant growth model. Constant growth, and what is growing? It's about dividend. Dividend, that means dividend is growing at a constant rate. Okay, so if you think about it, although the model number one and model number 2 may sound alike, it's just the way they sound. They may sound alike, but they are completely different. They are completely opposite, actually, if you think about it, right? Why? If dividend is constant, meaning it's not growing at all, right? The growth rate is 0, but as opposed to that, here the growth rate is constant. That means, right? Model number 2, the growth rate is constant. That means the dividend of this stock is growing at a constant rate. So obviously they mean, they are completely contradictory. I mean, model number 1 and 2 are 2 different, completely contradictory situations, right? Now, number 3, model number 3 is called variable growth model. So of course, what is growth of what? Of course, dividend, right? And that means, dividend growth rate is variable; it varies. And therefore, number 2 and 3 are a kind of, contrasting, situations, right? They are basically 1 and 2 are contrasting situation. 2 and 3 are contrasting situations. Of course, 1 and 3 are also, quite contrasting situations. So let me pause this PowerPoint and go to the whiteboard. And first of all, let's think about what discounted cash flow model is. Now, if you think about it, when we say stock valuation model or bond valuation model, what are we looking for? In bond valuation model, if you remember, right, in bond valuation model, what was the bond valuation model like? What is it? First of all, I used B for the symbol, right, for price of the bond. But what does price of the bond mean? Remember, doesn't that mean the present value of the bond, right? Present value. Of course, it means intrinsic value, right, or rational price, or intrinsic value, or a fair value. But what is a fair value or intrinsic value supposed to be? What does it supposed to mean? What is it supposed to mean? What it's supposed to mean is the present value of all future cash flows discounted to time 0, to present. Remember, right? So anything, if you are valuing something, right, what is it that is? What is it worth today? What is it worth today? Okay. And since financial assets bear fruit in the future, all financial assets bear fruit in the future. goes without saying. So the present value of all those future cash flows, right? That's the value of that asset. But if you look at the also real estate, right? What is the a value of that real estate? I mean, if it is, of course, just residential property, right? You're buying. What determines this value is, first of all, most intrinsic elements of value. Most intrinsic elements are. So, what's the cost of construction, right? What's the cost of building it? The material that went into it, the price of the land that went into it, and etc. Right? Plus, labor, use of capital, right? Like construction equipment. But other than that, right? Also, what factors into pricing of residential home is, the neighborhood, right? Is it upscale neighborhood? Is it a downscale neighborhood, upscale neighborhood? What other homes of the similar? What other homes of the similar size in that neighborhood sold for? The most recent transaction, most recent sale of any residential property in that neighborhood, right? That would be also the benchmark, right? That would build into pricing that property. But if it is a commercial property, what is the main determinant of a commercial property, right? Or investment property? Isn't that the future cash flow? Isn't it right? How much rent is it going to generate? Isn't it right? Of course, the how much traffic is there? I mean, the commercial traffic, how many? Is this a hot area, right? How much commercial traffic is there? People, is there a lot of people coming here to shop? Is there a lot of people looking for a place to sleep, or for looking for? Is this a hot place for people to come looking for their apartment, place to live, or place to shop, place to dine out? All factors, right? Represent future cash flow, right? Potential future cash flow, and a very good, steady measure is the rent, right? The potential rent is going to generate. I mean, the rent is pretty much, set for a number of years, right? If any, between any lessor and a lessee, right? If you sign a contract, right, a lease contract, right, then the rent is fixed for a given number of years. So this is a pretty good example of annuity, isn't it right? So wasn't bond basically built on annuity, right? Isn't that the present value of all the? So we know the bond valuation formula, right? It's annuity, present value of annuity, plus the present value of just in other words, sum of all the present value of all the. I'm sorry, I was trying to write it. But that's okay. All the annuity payments. That already means a present value of sum of all, right? Annuity payments plus the present value of the maturity value, right? Face value, right? Or the future value or redemption value, right? So what does that mean? Discounted cash flow model, as an example, bond valuation model is a very good example of discounted cash flow, because you're discounting the future cash flows. Now, so just like that, if you think about it, what is the cash flow in stock? What is the future cash flow in stock? In case of bond, is the coupon payment, interest, right? Coupon payment, coupon interest. In case of stock, what is that? In case of stock, it is dividend, future cash. So dividend at time 1, right? And then, of course, 1 plus R, right? We'll have to discount it back to present. And dividend is actually, in reality, it's not like dividend is quarterly. So to apply this model, it has to be, quarterly. I mean, the time, the frequency is, frequency of time is quarterly, right? Now, dividend at time 2, 1 plus R squared, right? And we can keep going. Okay, instead of dot, right? I'll just use ellipsis. And then, but then think about it. How far do we go? How long into the future do we go? If you think about it, stock doesn't have any end point, right? Remember that? Stock doesn't have any end point. So it keeps on going forever. And think about it. as long as the company goes on, the stock goes on. So we will have like dividend at time infinity minus 1, and it will be raised to 1 plus r divided by, right, infinity minus 1, and then if we can call time, I mean, infinity, infinity is just it's not the end point. It's just the because we cannot. It's pointless and meaningless to keep extending it, right? We just treat infinity like as just for convenience sake, just to represent some terminal point, right? 1 plus r raised to infinity, right? Okay, so it keeps going like that. Next question is then, what about the, okay, I mean, doesn't that look like this? Pretty well. Sum of all the present values of dividends, right? Going to infinity. It's just that, unlike the bond, there is no end point, right? Because in the bond, there is no terminal time. But for stock, there's no terminal time. It just keeps on going forever. And the terminal point is infinity. And infinity doesn't end, right? So, okay, it's like this part, right? Dividend, right, is like the coupon part. What about the then face value? I mean, future value of the stock. Yeah, we'll have to also, that will be the cash flow, right? So whatever the future value may be, the future value that at infinite time, future value at infinite time, that future value will have to be discounted by infinity, right? Now, but let's think about it. Is this going to be a relevant value? Is this going to be a relevant quantity? Why? Actually, my answer is no. This is going to be irrelevant. Why? Now let's think about it. The the future value of the stock at infinite time. What do you think it's going to be? You might think because it's the future value at an infinite time, at an infinite point in the future, you think it's going to be an infinitely large number, right? But the answer is no. No, it's not going to be an infinite number. It's going to be a finite number, always. Finite number. Why? Now let's think about it. You understand that the stocks stocks are basically, most of the stocks are cyclical, right? What does that mean? It follows the business cycle, right? It follows the business cycle, right? Some stocks are counter-cyclical, right? Counter-cyclical meaning, not following the business cycle. It's actually going against the business cycle. So when the most stocks are cyclical, meaning when the economy is good, the stocks are, stock prices are going up, right? Stocks are doing well when the economy is good. And when the economy is bad, stocks generally do bad as well. Because, companies, it's when the economy is good, companies are generally doing well. When it's bad, most of the companies are doing poorly. So stocks represent those companies' values, right? Companies' performance, right? Companies' earnings, right? Remember? So most stocks are cyclical. So as they even in like 1,000 years, or even 10,000 years, 100,000 years. Let's say Apple is still around, right? Apple is still around 1,000 years from now, or even 10,000 years from now. The company will keep going as long as the Apple's product is delivering value, right? If Apple's product is considered useful, right, and innovative, right? And, I mean, think about it. There's a reason why you go to prefer one restaurant to another, right? If there are restaurants, they generally serve the same. It's all let's say street food vendor, right? They sell pretty much, let's say, same thing, right? Like halal, right? But there's clearly a reason. Halal is basically, or pizza. They're basically slightly, they may be differentiated, but they are pretty much standard, right? Standardized. But there's one reason you prefer one food vendor, food truck to another. Why? Because and if that place is hot, there's a reason. Even for people generally go to the Shake Shack burger, and Shake Shack burger is a has already gained global reputation, right? And the reason, but you can find burger joints anywhere. Of all those burger joints, why Shake Shack is most preferred? I mean, in general, I'm not saying everyone prefers Shake Shack, but well, think about it. Because there's something different about it, right? It's differentiated from other competitors, right? And although hamburger is pretty much homogeneous product, right? But even among the homogeneous products, significant differentiation is a key to success, right? And a significantly differentiated product is generally differentiated, to the upside. In other words, it tastes superior or much better than other competitors. And then if that's the case, that's where that's where the innovation is. Shake Shack developed their own recipe, which is innovative. Just like that, one food truck that sells, that you go to, it's there are hundreds of halal food trucks in the city, but if there is one place you prefer, because they have innovative, right, ingredient or innovative, recipe, just like that, as long as Apple has puts out innovative products, significantly differentiated from their competitors, then of course the mobile phone industry is not that widely competitive. I mean, there are only not everyone can, right? It's not like a straight food truck, right? It takes huge capital investment, and you must have very state-of-the-art technology, right? But anyway, so there aren't that many mobile phone manufacturers around the world. But anyway, if Apple is still around, like 10,000 years from now, right? 1,000 years. Instead of saying infinite future, let's be more specific. Even 1,000 years from now, what's going to be the stock price of Apple? At the time, 1,000 years from now, think it's going to be millions of dollars? No. First of all, there are two reasons it's not going to be a huge amount, right? It's not going to be millions of dollars. Why? First of all, you remember I just said there's business cycle. Most stocks are cyclical, so there will be over like thousands of years. There will be not just several. There will be a number of there will be like hundreds of business cycles, right? Because the economy is a cycle. There's of boom and bust, right? We've had a very good we've had a bull market or expansion, right? Bull market is for stock market, but overall for the macroeconomy, we've had a like a decade of expansion after the last financial crisis, 2008, right? And then 1990s, and they say that was the longest period of expansion ever, but also 1990s, the whole decade. It wasn't the entire 10 years, but almost the entire decade of 1990s was also an expansion, a period of continued expansion. And 2008 through 2000 or 20, and before this March, before the COVID-19 crisis, it was more than a decade of expansion, right? Almost, So, because of the business cycle, because of the boom and bust, the market will, every time there's a bust, the market will lose 30%, 40%, and then crawl back up, and then bust again, So through these series of cycles, the price doesn't just simply keep going. I mean, the trend, if you the long-term trend is upward, upsloping generally. So thousands of years later, we can expect the price of Apple would be greater than what it is now, but in general, right, as a trend. But it doesn't mean it's going to be an infinitely large number. And second reason is more important. Now think about it. Remember there's a stock split. Remember that I told you Apple had a split back in 2014. I mean, there were several splits along, in the history of Apple. And Apple has been, Apple is only about 40 years old, right? Because it went public in 1981, right? So Apple is only about 40 years old. Now, until it is 1,000 years old, of course, it's a long, it's a long way. But at least, think about it. Even in the last 40-year history of Apple had several splits. And the last time it had a split was around September of 2014. And why do they split? Huh? I explained to you why the stock.
Well, just to update on that, Apple even split last year, just around. Amazon also did that. Google also split, I believe, around August of 2022. But you can check. Let me check on that. But it's quite obvious. Any stock, if the price gets onerous for trading, then they split, right? So a good reason why price doesn't grow infinitely, right?
Stocks split. Remember, when the price gets too onerous, right? When the price gets too pricey, it lowers the marketability. That I used, the example of corporate bond and the municipal bond, right? Municipal bond with $5,000 face value. Although it's the municipal bond, muni bond has the advantage of tax break, right? I mean tax advantage, right? But despite that advantage, most individual investors don't get into muni bonds. It's mostly institutional investors that get into a muni bond. Why? It's all because of that high face value, right? High par value, right? And then if you have limited funds, right? You don't want to tie up. You don't want to tie up large amounts into an instrument or asset that is hard to liquidate, right? And that for that reason, and you cannot partially liquidate when you need to cash out only partially, right? So this is this lowers the marketability of the stock, right? That's why Apple, split in last time Apple split in 2014. That's why they did it, because at the time it was about $660, and they did like 8 to 1, 7 to 1 split or something like that. Yeah. So because of the stock split, right? And there are like Google is about $2,000. There are and also Amazon is about $2,000. They're going to split at some point. It's not going. They cannot keep Amazon and Google are still in demand, but it will be more in demand if the price is more affordable, right? Or more marketable. So because of that, because of the simple fact, or two reasons, the future value of the stock at infinite future is still a finite number, right? Still a finite number. On the other hand, what's this going to be? What's it going to be? Remember, this is a number greater than 1, right? So it's not 2, but a very useful fact or simple, mathematical thought experiment can arrive at this simple fact. But we all understand that number, if you raise 1 to infinity, it will still be 1, because raising 1 to any number, it will still be 1, right? But a number less than 1, between 0 and 1, right? Number between 0 and 1, like 0.5, if you raise it, the more you raise it to power, the more you raise it to a higher power, the smaller it will become, right? Simple thought experiment. 0.1 squared is 0.01. 0.1 raised to the third power, 0.001, right? To the fourth power, 0.0001. It gets smaller and smaller and smaller, right? Because it's a simple fact, right? 0.5 squared, 0.25, right? 0.5 to the third power, 0.5 times 0.5 times 0. You can tell it's getting smaller and smaller. But suppose 1.5 or 1.2, 1.1. If you raise it to a higher number, it will become greater, right? It will become a greater number. And by raising such a number, greater than 1 to infinity, what's it going to be? Of course, it's going to be an infinitely large number, right? In other words, it's going to be infinity itself. I'm trying to write it when I can. Infinity, or simply, right? Infinity, the symbol. Now, then think about it. You're dividing a finite number by an infinitely large number, right? Dividing a finite number by an infinitely large number, what's it going to be? It will become a very small number, infinitely small number, right? You don't have to actually use a number, but just by a thought experiment, right? It becomes very clear. Just by divide any finite number, right? You made 10 million, even 1 billion, 1 trillion. Still, that's not infinity, right? It's a huge number, but still, it's not infinitely large number. So divide any finite number by an infinitely large number, it will still be a very small number, right? Very small number, meaning divide any finite number by infinity, it will become an infinitely small number, or there's a name for that, infinitesimal number, infinitesimal, which is close to zero. Isn't that right? Infinitesimal number is basically close to zero. It doesn't become zero, but it approaches zero. It's going to be a very, very small number.
All right, so time is up, and at least this is a very important point, that the future value of the stock doesn't matter. It's irrelevant. It's not going to enter the valuation formula, because it drops out as an infinitesimal number, right? Because it's fairly insignificant. It doesn't affect the valuation. Anyway, so we're going to pick it up from here tomorrow. All right. So class is dismissed.
Thank you so much, Professor. Have a good night.
You're welcome. You're welcome.
Thank you, Professor. Have a good night.
You're
Have a good night.
welcome.
See you tomorrow.
All
tomorrow.
righty. You too. Thank you. All right. Go in peace, and I will see you guys tomorrow. Okay. All right. So stop recording and